Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. And, as an investor, I consider myself a fundamental value investor. I also call my investing philosophy, or refer to it as business perspective investing. And I bring that up because there is a fundamental difference between being a trader or a speculator in stocks versus investing in the business. And this distinction is very important because too much in the quote-unquote investment world is focused on stock price and stock price action. And not enough, in my opinion, interest and attention is being placed on fundamental values of a business. What gives a business its value? And I write about that, and I talk about it, and I video about it all the time. But this particular video today was inspired by a comment on my last video that referred to a video from another YouTuber who titled his video loosely, and I may be saying this wrong, he titled it something about the dividend fallacy, dividends don't add to your wealth. And he also cited an academic paper in his video, and the point that they try to make is that dividends really don't give you any more. Dividends actually reduce the value of the business when they're paid you. So you're really kind of getting your own money back, and you're not really getting any incremental value. And it's certainly the dividends are not increasing your wealth. Well, that is absolute unadulterated hogwash. That is not true. Dividends, for many, many reasons, I'm going to try to cover as many as I can throughout this video, have been one of the most important components of investing in common stocks for the long-term prudent value investor of any, and they've added tremendous amount of wealth to people. And here's the rub, and here's the real fundamental difference. I'm going to go ahead and get into the nuts and bolts of the video here and use some of my FastGraph tool to try to illustrate some of the points that I want to make. But what I'm going to do is I'm going to clearly try to illustrate to you that dividends not only add wealth, they're a very, very important component of total return. And this point may be perhaps the most important. If you, ceteris paribus, take two equal companies with identical growth rates, and one of them pays a dividend and the other doesn't, and you measure them appropriately based on fair value to fair value, the one that pays a dividend will always give you a higher rate of return, ceteris paribus, all things remaining constant. Because the total return that an investor receives is a function in all investments, whether it's bonds or stocks or real estate or whatever it is. Total return is always a function of capital appreciation or growth, as some of you think about it, plus income, which could be dividend income, interest income, distributions, etc. Okay, so the point is you get capital appreciation and you get dividend income. And those things are generated from a source, and that source is the operating results, in the case of a common stock, of the business, the cash flows and the earnings that business generates. And it's important to remember as I go through this that the business is continuously producing earnings and cash flows. Sometimes those earnings and cash flows are growing, and those are the kind of stocks you want to own. Sometimes they're not. But the important point is price is not value. Like Warren Buffett once so famously said, price is what you pay, value is what you get. And he also pointed out that he'd be a bum on the street with a tin cup if the market was always rational. So stock prices are not always rational, and they certainly do not always reflect the intrinsic value of the business. And when you're thinking of value, you need to be thinking about the intrinsic value of the business you're investing in. As an investor in common stocks, by the way, is what I'm referring to there, and worry less about price volatility, which is something that is real, it cannot be controlled, and it's going to happen continuously. So let me try to get into some of these points that I want to talk about. Now, this gentleman that produced this video, calling it the dividend myth, that dividends don't add value, based it on price action. And his argument is, and he cited an academic paper in the video that also put out the same hypothesis, is that the stock is reduced by the exact amount of the dividend on the pay date the dividend is paid. Okay? Now, they then try to say that that's fundamentally different, and I guess you would say they're implying inferior to the interest you receive on a bond. Okay, well, what they fail to recognize there is, and I'll get into that in a little more detail here as I go, when you buy a bond trades with accrued interest. Okay, if you buy the bond or sell the bond in between interest payments, the buyer has to pay the seller the accrued interest on the bond in addition to the bond price. And that's fundamentally no different than the price being adjusted when the dividend's paid. It's, first of all, a very temporary point, and the stock can begin trading immediately after that, and before the day's over, it can actually be trading at a value or a price, that's higher than it was when it went ex-dividend. Okay, when the price was adjusted for the dividend amount. It is simply a methodology of the exchanges to keep investors from double dipping, from buying a stock, getting full price for the stock, and then getting the dividend on top of that. Okay, so the idea is, in other words, keeping people from waiting to the day before the ex-dividend date, buying the stock, and then getting the dividend and getting, in essence, a free dividend. Because the accrual of the dividend is very similar to the accrual of a bond. A dividend is usually paid quarterly. Some companies pay it monthly, some even pay it annually, some even semi-annually, but generally dividends are paid quarterly. And so from one quarter to the next, as the owner of the stock, you're accruing the dividend, just like if you own a bond, you're accruing the interest on a bond. And again, if you sell a bond, which typically pays every 6 months, 3 months into a 6-month period, you have to pay if you're a buyer, you have to pay the seller the price for his bond, whatever it's trading at, plus the accrued interest that he's entitled to. In other words, you're not going to buy it halfway in the middle of a payment period and get the full interest rate. You're only going to get partial. So it's quite frankly no different with bonds than it is with stocks. But here's the point. These academics and this gentleman that did this video, they are strictly price phobic. All they see is price. This is a graph of Snap-on where all I have is the price on the graph. Now, I want you to notice a couple of things. There's an awful lot of volatility in the stock price. Okay, that's really clear. But here's the point that I want to get at. The stock price is really functionally related to the company's earnings. This orange line is the value of the business, not the price line. The price line represents the market value of the business. But as I've pointed out over and over and over again in videos, prices can get disconnected from the orange line, and they often do, but they eventually revert to the mean and come back into alignment. And the same when a stock gets overvalued and comes back into alignment, a stock can get undervalued and come back into alignment, and then it can easily go out of alignment again. And it can do this over and over again. Stock prices are volatile. Okay, so the idea that the stock price is reduced by the amount of dividend and it's saying that this company that you've got less value when in the business when the company paid the dividend is also hogwash, and I'm going to cover that for you in more detail here a little bit later in the presentations. But I want to show you, so I'm going to use Snap-on here as an example because it's really critical. There are two components to total return, as I stated earlier. One is capital appreciation. Capital appreciation is when the price goes from point A, here I've got December 31st, 2007 on for Snap-on, where the price was $48.24, and over time, through the end of November 2020, the price rose to $175.85. That capital appreciation, that is strictly growth. The price going from $48 to $175 is growth. But here's the point that these geniuses that think dividends have no value forget. And that's why I designed fast graphs the way I did. The orange line is representing the capital appreciation potential of the business, okay? But I want you to notice here, I've adjusted this so I got fair value at the end of the period, i.e. the price touching the orange line, versus fair value at the beginning of the period. Because when I do that, what that says is the growth component here, the capital appreciation, is going to be very, very close to the actual growth of the business. The source of value is the growth of the earnings, not the day-to-day fluctuations of the stock price. So when I look in performance of Snap-on here, if I look at the growth component only, I discover that, the growth component of 10.2%, and that's the key number here, is virtually aligned or identical to the 10.35% growth. You've just got very slight PE ratio. You got a PE of 1488 going to a PE of 1505 here. So that's the variance, that's the difference. But essentially, the growth rate of the business, the operating history of the business produced the growth which produced the capital appreciation of the stock. Now, in addition to that, and this is why I designed fast graphs the way I did, this company also pays the dividend. And this white line plots the dividend. And a couple of very important factors about that is, the dividend for good, high-quality companies tends to grow. As you can see, they had a flatline dividend during the recession. They didn't cut it. They didn't raise it. But then they've raised their dividend every year since. The dividend went from $1.20 to $1.22 to $1.30. Skip a few years to $2.54, $2.95, $3.41, $3.92, and then, $4.47 for, December 2020, which was, the end of the fiscal year 2020. So the dividend also increased. But what I then do is I take this area below the white line as the dividend payout ratio. This is this portion of the earnings that are paid out to the shareholder in the form of dividends. Okay, I take that piece and I stack it on top of the orange line to illustrate the point of the two components of total rate of return. You get the capital appreciation, the price going from point A to point B versus the dividend income. Okay, and when you've got to judge this when valuations are in alignment, that's really a key point here, because there are times when the price will get out of aligned on the upside and out of aligned on the downside. When it's above the line, you'll get a higher rate of return than what the company provides. When the stock price is below the line, you'll get a slightly lower rate of return than the business generated for you. But over time, that ends up evening itself out, and you end up getting the value of the business. Your value of your company comes from its ability to generate earnings and cash flows. That's critically important. So let's move on now. Let's look at another stock. Let's look at Johnson & Johnson, which is a Dividend Aristocrat. And I want to make a couple of comments here about Dividend Aristocrats while I'm waiting for it to load. The thing about this dividend growth, one of the other arguments that these geniuses try to make is they try to talk about the fact that, the dividend can be cut. Okay, or and it's not guaranteed. Well, bonds can default as well. Okay, so, that's not necessarily a great argument, but if you build a dividend growth portfolio and focus on things like Dividend Aristocrats and Dividend Champions, which are simply companies that have increased their dividends by 25 years or more, including through the Great Recession, I might add, then, your odds are pretty high that you're going to do well. And if you diversify properly, even if one or two of them cut dividends, the fact that the other stocks in the portfolio are increasing their dividend every year is really a great benefit. So let's look at performance on Johnson & Johnson for a moment. But before I do, let me make a point again. If I draw the price from here to, I'll draw it to the orange line, which is, 6 months away, you have a 7.5%, total rate of return, but about 6 or so percent of that is growth, and the rest is going to be a function of capital appreciation. Now, the actual performance through this time frame, let's go ahead and look at it and illustrate what I mean. What I've done is I've taken the additional settings here, and usually we use a $10,000 example. I've put it up to $100,000. I'm going to be comparing this to a bond here in a moment. So assuming you invested $100,000 in Johnson & Johnson, and I kind of overwrote my chart here. Let me get it back calibrated. So if you put $100,000 in Johnson & Johnson on December 31st, 2007, your dividend yield would have been 2.7%. By the way, had you bought a bond at approximately the same time, a 10-year Treasury bond at approximately the same time, your interest rate would have been about 4.04%. So you got more interest from a Treasury bond than you got income from Johnson & Johnson. But I'll cover that in more detail later. But I do want to make this point. You have what I like to call growth yield. The first year, your yield was 2.7, but then it increased to 2.9, and this was your income. You got 2,691, 2,800, 3,100, 3,300, 3,500, 3,800. By 2013, you got 4,137, or actually now you're equaling the Treasury bond, and then every year thereafter, you get more income than the Treasury bond. I just want to point that out to you, had you put the same $100,000 in a Treasury bond. This is growth yield. This is one of the great advantages of investing in dividend growth stocks over investing in a bond. But here's the other difference. Put that same money in a bond, you'd have got $4,040 of interest each and every year. And this gentleman tried to point out there's a fundamental difference, he said, between interest and dividends. Well, that's kind of true, but it's really not. It's still income. It's still cash. Once you cash the dividend check versus cashing the check from the Treasury bond, you have cash. Okay, and that cash is cash, and there's no difference between the money that came from a Treasury bond and the money that came from a dividend. If you went to the store and bought something with it, they wouldn't give you more change on the interest payment cash than they would on the dividend cash. Cash is cash. But the point is, it is slightly different. There is a difference in what it costs. But remember, you've got to pay accrued interest if you trade bonds. So the bond value, if you will, is also, in hypothetically or in theory or fundamentally being reduced because you got to pay the interest to the owner that owned it during the holding period that he's entitled to, where he accrued the interest. But that's not the point. The other point is that $100,000 you invested in that bond would be worth, and say it matured at this date, would be worth $100,000. Okay, where in the case of Johnson & Johnson, the 100,000 grew to 254,000. That's how you fight inflation, ladies and gentlemen. And I'm going to talk about that in much more detail later. But I want to get back into this notion of the bonds because I'm using today's price as Johnson & Johnson's trading right now. If I look at Johnson & Johnson again, if I go back to their dividend payment, they're paying about $4. That year, they paid about $4 in dividend income. Now, my performance going to adjust. It was $3.98. So let's say they paid, roughly $1 a quarter. Okay, I just want you to have that number in your mind, $1. Okay, this is Johnson & Johnson today. Say today was the ex-dividend date, and the stock adjusted by $1. There's that dollar adjustment right there. And this isn't the ex-dividend date, but there's that dollar adjustment, right here. But then as soon as that adjustment happened, the price is trading again. The stock is constantly trading every day. And if I look at 5 days, you can see a drop in the value, like would have been a dividend, ex-dividend payment date, and then the stock goes on and appreciates up. Stock prices fluctuate. They constantly fluctuate. In a month's time, you can see the price volatility, changing quite dramatically here using Google Finance. Over a year, you can see a lot of volatility in stock price. This is not what gives you value. This is market value. This is liquidity. This is what you can sell the stock for or buy the stock for at any given moment in time. The value of the stock does not come from the price. It comes from the growth in earnings and the growth in the dividend income. And again, they're stacked on top of each other because when I measure price, fair value to fair value, I get a growth component, but then I also get a dividend component on top of that, which expands my rate of return dramatically. It's not a myth. Dividends they're not free. They're simply a part of the total return. But let me go into something even more fundamentally important about that. Let me go ahead and go into fund graphs because I want to make a couple of other points here. So I'm going to start with Snap-on. All right, go back to what I showed you with Snap-on. And what I want you to see is this is the return on invested capital. Okay, so Snap-on, earns about 13% last year on their capital. For the quarter ending in December of 2020, they had a return on invested capital of 13.27%. Okay, now I want to do another thing for you here. I want to go in here to the fund graphs here, to the in millions graph here, and I want to show you on the balance sheet, this is the cash that the company has. Okay, this next part, the blue line here is CapEx, okay, or capital expenditures, what the company invests to keep the business running and growing and functioning. The point is they've got all this cash, okay, if they don't do something with that cash, they might be earning, 0.5%, 1% on the cash, having it invested in CDs or, short-term money markets, whatever, which are virtually paying nothing today. That cash is actually reducing. Let me say that again. That cash is actually reducing the return on invested capital because it's earning significantly less than what the return on invested capital. And I think it was Warren Buffett, and don't quote me on this because I'm not positive about it, but Warren Buffett once said that he's seen much more money destroyed by overzealous CEOs who were, aggressively investing and, making acquisitions and reinvesting shareholder cash into things that they either didn't know anything about or had lower returns than what the existing business was generating, and therefore ended up destroying investor capital. Having this cash sitting on the balance sheet, it makes no sense to just keep it and hoard it. What you do with the cash is you pay dividends. Okay, you give some of that cash. Now you got to keep some cash for investment, but now this light blue line is the dividends. They're using this cash to pay their dividends and their operating cash flow that comes along as well. But the point is, that's not decreasing the value of the business. It can actually be increasing the value of the business because it's allowing the company to generate a higher return on invested capital, which in turn will give them the ability to generate more earnings growth. I'm back here to Johnson & Johnson. And let's go through the same process with Johnson & Johnson. So let me change the symbol here. And look, I want to drive this point home. If you are a CEO and you're a big company like Johnson & Johnson with this mega market cap, okay, which I'll get into here in a moment, and you look at the company now, number one is, let me get rid of some of these. I got some things queued up here. If I go into the balance sheet and I look at cash on the balance sheet, Johnson & Johnson generates a lot of cash. If I go and look at their capital expenditures, you could see that their capital expenditures, what they need to keep their business fresh and their businesses operating and, research and development, et cetera, what they got to invest in the business is a lot less than their cash. This excess cash above what they need for CapEx, if they have nothing else to do, if they don't have an acquisition to make where they can get a higher return on their invested capital, than they're currently earning, and they're earning about, they earned 16% return on invested capital at the end of 2020. And again, they're earning maybe 1% on the cash. It makes sense. The best thing they can do is return that cash to the shareholders. And it isn't reducing the value of the business. It can actually be enhancing the value of the business because it's making the business more profitable. It's allowing the business to generate more earnings growth going forward and more dividend growth. Or it's simply allowing the business to generate more cash flow and more free cash flow, which is the source of the dividend, not the fluctuating stock price. It's the cash flow. And as you can see, Johnson & Johnson generates significantly operating cash flow above what the company pays in dividends. Okay, so this notion that, dividends are it's a myth that they add to your wealth is garbage. Dividends tremendously add to your wealth. And let me go into some other data on that. I went into a website here just for your pleasure and your edification. This is Janus Henderson Investors. They did a white paper on the importance of dividends to total returns. And they talk about a lot of things in here that are interesting. But one is they do this famous Ben Graham quote where he says, basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Ben understood the importance of dividends and the value that dividends brought. And the same study went in, I'll put links in the video to this document. They also talked about the amount of returns in this white paper of dividends versus capital appreciation. And dividends have produced historically a pretty significant contribution to the average total return. And this is another one that they try to argue quite a bit. And that is there was no capital appreciation from on the S&P during the 2008, 2009 catastrophe, but we did get dividend income. And let me go back to that and talk about Johnson & Johnson here. And I'm going to expand this graph out a little bit so you can clearly see what I mean. Okay, remember, this is Johnson & Johnson's dividend. This is the dividend after it's been paid out. This is the price. And this gentleman does this white screen box where he talks about how the price of the stock fell, blah, blah, blah. Well, notice, yes, the price of the stock fell, but Johnson & Johnson's dividend kept rising. If you were a prudent investor invested in Dividend Aristocrats and champions like Johnson & Johnson, your income continued to grow. If you were an owner of this stock, your dividend during 2008 and 2009 on a $100,000 investment would have went from $3,400 to $3,700 to $4,000 to $4,300, et cetera, et cetera. And the price fluctuation was only relevant if you were selling. But if you're a prudent long-term buy and hold investor, you're not selling the stock, you're buying the stock and you're holding the stock for the long run. That's what business perspective investing is, because the value of the business is coming from the earnings and cash flows and not the fluctuation in the stock price. Look at Johnson & Johnson's stock price. It's always fluctuating up and down. So these short-term drops in price because you have an ex-dividend date is meaningless. What's important is the price of Johnson & Johnson has continuously increased over time, as the red line is showing. It's been that's the slope of their increase, which in this case is about 5.5%, plus the dividend income. So, here in this long-term graph that showed, that you had 83,000 in dividends, it turned 10,000 into 328,000. Dividends matter, and they matter a lot, and they do add wealth, and they are a component of total return. And the fact that they go ex-dividend date and the share price temporarily drops for an hour or a half hour, a day, or a month for that matter, it doesn't matter, doesn't mean the value of your investment has been diminished. It hasn't. The value of your business, because the company is continuing to grow their profits, just like Johnson & Johnson and Snap-on and the others I've showed you here. Okay, so, that's the real key. So let's go look at Treasury bonds now, because there's another thing. I want to be fair here. If you look at stock values versus bonds over the last, let's say, since like, say, 1990 or so, or 2000, you'll find that bonds have actually outperformed stocks. Okay, but there's a reason for that, and knowing that reason is critical. Bonds have outperformed stocks because interest rates have constantly fallen. Okay, and when interest rates are falling, the value of existing bonds tend to rise because they pay more than a new bond that's being issued. Okay, so the reality of it is you would have great performance. So if you look at, since 2000, if you look at the Vanguard Long-Term Bond Fund versus the S&P 500, what you'll discover is that the bond fund actually outproduced the market. But that's because we had this significant dropping of interest rates. If interest rates begin to rise and this graph turns and starts going in this direction, like it did back, in 1977 up through, where you got rates up to 13 or 14%. By the way, when the Treasury bond was paying 15%, I saw absolutely no reason to own a stock. Today, with the Treasury bond paying, roughly 2%, I see no reason to own a bond. It's just that simple. When the interest rates were, 7, 8%, bonds made a great deal of sense. You got to make investments based on the relative value that the investment is offering you. Okay, that's critical. But this only happened because of what I just showed you. Now, if rates begin to rise, that's not going to happen anymore. So this idea that dividends are not free is a lot of balderdash. But let me move on here and finish this video by producing something else that I think is critically important. I've created some PowerPoint slides for you here because I want you to talk about, I had a gentleman once, a gentleman I was very young in the investments business, did a presentation for, he was a mutual fund, what they call wholesaler representative. He told us a story about guaranteed failure. And guaranteed failure was you invest in a bond. Here I'm using a 10-year Treasury bond yielding 4.04% with a $100,000 investment in it back in 2008. And he called it, this was guaranteed, as close as you could get to guaranteed anyway, of any investment that exists. But he called it guaranteed failure. He said the reason is because you had inflation, and I didn't include taxation in this. We'll assume this is in a tax-sheltered account. I want you to see the dynamic here, the difference between investing in a bond versus investing in a dividend growth stock, especially a Dividend Aristocrat. The bond paid fixed interest of $4,040 a year. These were the inflation rates for each of these years. This reduced the value of that payment you got, at the end of the year. It only had $3,800 in purchasing power in 2008. The payment you got in 2013 had $3,900. There was a period where inflation actually dropped. We had negative inflation, if you will, or deflation, and the value of the income of the bond actually increased slightly. But otherwise, inflation reduced it. So your actual income stream was $48,480. If I adjusted each of those years individually, that means that you only ended up with about $47,000 in purchasing power. If you put that same $100,000 in Johnson & Johnson at about a 2.87% yield, or 2.58% yield initially. You also had, or excuse me, it was 2.6, we'll call it 2.7, 2.69%. But Johnson & Johnson increased their income every year. Now, it took several years for there to become parity between the bond and the dividend payment of J&J and the interest on the bond, even with adjusting it for inflation, okay, which is this number here. But eventually, Johnson & Johnson's dividend actually increased to more. The end result was, interestingly enough, over this 12-year period, you would have gotten just about the same amount of money, actually just slightly more cumulative total dividend inflation-adjusted income off of the dividend growth stock Johnson & Johnson than you would have interest off of the 10-year Treasury bond adjusted for inflation, okay? But the bigger difference is that $100,000 face value of the bond was decreasing in value each year based on the inflation rate, okay? Because at the end of this 12-year period, it paid you nominally back the $100,000. That's what you got back. But that $100,000 12 years later only bought $80,691, if you will, worth of goods and services. It still said $100,000, but it only had the purchasing power of $80,000. Now, I reversed that because I took the $218,000 that Johnson & Johnson would have ended up with at the end of 2019. It's a slightly different what I showed you before because I'm using 2019 here, not 2020. But that $218,000 would have only had inflation-adjusted purchasing power of $176,000. But the question is this, or about, in other words, you lost about 19% of your purchasing power over this 12-year period due to inflation. But would you rather had 80,000 or would you rather had 176,000? Don't answer that question. Okay, now I did another one for you. I took a higher yielding stock, Enterprise Product Partners here, which had a 6.45%. Now, this is also slightly different, by the way. This is a distribution. This is a master limited partnership. It paid a distribution, not a dividend, and not interest, but it's still cash at the end of the day. And you can look at a stock like this and generated significantly more distributable income, cash in your pocket, than the bond did, and certainly more than the dividend did. Now, this didn't generate the capital appreciation that Johnson & Johnson did. There's always that trade-off, but it did give you, quite a bit of advantage in terms of purchasing power, was still significantly better than what you got from the bond. And of course, your income was incredibly more than the bond, more than twice what the bond paid. So, there is value in investing in these things. Now, one final thing I want to point out here is the fact that this works. You can buy junk, okay? You can buy bad investments. I want to be fair here when I do this. If I would have invested in something like General Electric, for example, over this same time frame, just to be clear, General Electric wouldn't have worked out. I'm not saying buy any dividend growth stock. I'm saying buy the best dividend growth stocks you can see. As you can see, General Electric's cash flow fell dramatically. You can see they cut and virtually eliminated their dividend. And now I've got earnings on here, and you can see the performance of General Electric over this time frame would have underperformed a bond and every other stock I showed you. The key is to buy these dividend aristocrats and champions. These are companies that have increased their dividend for 25 years or more. Okay, instead of interest, stocks pay dividends. This is an article in Forbes magazine by Lawrence Correll on, I think it was July 30th, 2020, so very recently. And he points out that's a way for companies to distribute a portion of their profits back to shareholders. Much like bonds, when the stock share price falls, its dividend yield rises, and many stocks taking a share price cut during the market turbulence, some dividend yield has soared into double digits, like you saw, with very close to what you'd have seen with enterprise products. But he also points out here, another article in Forbes points out that according to data from Bloomberg and the ETF firm ProShares, out of the S&P 500, 56 companies, 13% cut their dividends, but 74 or 18% of the index raised their dividends. Okay, but it gets better. It says when you go through the Dividend Aristocrats, one of the most famous elite groups of dividend payers is called the Dividend Aristocrats. To become a dividend aristocrat, the company must increase its dividend for a minimum of 25 years. Some of these aristocrats, by the way, have done it for 50 years or more, just as a sidebar. Okay. And they did this through the Great Recession and the bursting of the dot-com bubble, by the way, as well. So far through this year, through the end of June, only one S&P Aristocrat cut its dividend, according to ProShares. Only one. So the source of Aristocrats' resiliency is the quality of their balance sheet. I want to remind you, when you look at Johnson & Johnson, for example, it was AAA rated. Okay, and most of the Dividend Aristocrats are very highly rated stocks. So the point is, dividends add tremendous value. There's no myth about it. Okay, because the source of value is the orange line on this graph, not the price. Okay, it's the growth of the profits and the growth of the cash flows and the growth of the dividend over time. I hope this gave you some better insights into the importance of dividends and how they work and what their sources are and where they come from. Don't fall into the trap of believing that there's a myth that you're just getting your money back and the business that you're left with is worth less than it was before. The price might adjust temporarily, but 2 days later it could be selling at a lot higher price or even a lower price. By the way, it can work both ways. But in the long run, as long as the orange line is progressing, the dividend growth stock is the way to go, especially during these times of incredibly low interest rates. When interest rates are as low as they are today, it really doesn't make any sense to be buying bonds, in my opinion. But it doesn't mean I hate bonds. I like bonds when bonds make sense, but they aren't doing that right now. Sorry for the long video. I hope you enjoyed this. I really enjoyed doing it. This is a pet peeve of mine. I hope you got a lot out of this video. If you did, give me a like, give me a thumbs up, ring the bell, tell your friends, subscribe to my channel if you don't already, and I'll talk to you again real soon. Thanks for watching.